So, welcome back to the Kiln DeFi Rendez-Vous podcast. Today, we are joined by Michael Bentley, the co-founder and CEO of Euler Labs, the team behind Euler Finance. For those unfamiliar, Euler is a platform that lets you lend, borrow, and swap seamlessly in a single flow. Under the hood, it's built as a modular system where users can design and customize vaults, select their collateral, and manage risk on their own terms. On the Kiln side, we are recently crossed $400 million TBL in our DeFi product, partnering with platforms like Ledger, Trust Wallets, Safe, Bitpanda, and many others. And as we look at where to route that activity for our partners, Euler stands out as a natural fit. So in this episode, we'll focus on the Euler protocol. We'll break down how the architecture works in practice and where the protocol is headed next. Michael, thanks for joining us. Welcome to the show.
Yeah, thank you for having me. I look forward to talking more about what we might do together.
And we've noticed that Euler's TVL has been trending up these past couple of weeks and months. How are you feeling about that momentum?
It feels good. I mean, it's undeniably like a good feeling. We launched V2 back in September. I think the first couple of months were pretty slow on our side in those. We were probably. I think we'd made a few mistakes in the way we brought the product to market, and there was a little bit of low morale at that point because we'd spent so long building V2 and getting it out, and but once we managed to tweak and kind of solve a few problems, I think then we started to just find organic product market fit incredibly quickly, and things have just been up and to the right ever since. Really, it's been astonishing. It's probably grown faster than any of us could have imagined. So naturally, very pleased with that.
And that's fantastic to see. And we'll come back to the difference of V1 and V2 in detail. But maybe before we do that, I would love to understand how did you fall into the crypto rabbit hole in the first place, and how it came the idea of building Euler Finance.
Yeah, so before this I used to be an academic. I was an evolutionary game theorist. So I worked at the interface of biology and maths and computer science, really building models of populations and how they change over time, and thinking about in the sense of biological strategies, what strategies win, or what kind of strategies dominate, or like how can you get a balance of different strategies. So used to work on lots of like population processes and strategy based stuff. And naturally, there's quite a big overlap there, especially with DeFi, and thinking about, what's an optimal strategy in DeFi and like optimization problems. So in 2017, I started playing around with crypto, really trying to build trading bots. Actually, it was the first way I got in. I knew a little bit about neural networks and things. I thought, yeah, I'm going to be super clever here and make these neural network based trading bots. And as the market was trending up, they made some money. And as soon as the market started trending down, they started losing money. And I realized that I was just basically trading the average of the market. This is quite a nice lesson, early lesson about crypto. And then I just stuck around after that. And I think 2018, 2019, I got this idea to start building my own fantasy football-based trading game, and mucked around with that for a while, like forking some of the DeFi protocols, the early DeFi protocols at the time. There was a exchange called IDEX and Ether Delta and things. So I was mucking around with that and smart contracts. And then, 2019, 2020 came along. Obviously, DeFi Summer emerged, and that's when I participated in the hackathon. And I was trying to solve this problem about how you set interest rates in a decentralized way without a centralized party controlling them. So a lot of the early interest rate models in lending borrowing platforms like Compound were kind of heavily governed, and they relied on fairly frequent adjustments to the interest rate models. I was thinking, like, how can you just remove the intermediary out of that system as well? So yeah, came up with this idea based on something called control theory, and off the back of that, we won a hackathon, and off the back of winning the hackathon, we were approached by some prospective investors, and that's how Euler was born, September 2020.
Right. And from very early on, did you have this idea of where the protocol would evolve to, and this concept of a vault and how the protocol is today?
I'd say not necessarily, no. I mean, we didn't have a modular architecture with the first V1 product we launched. We had more of a monolithic like architecture, similar to Aave today, I think. Effectively like a single global market. It was slightly more isolated and fragmented. So what we were trying to do was find solutions to allow not just a short tail of like predominant major crypto assets to be using lending and borrowing, but actually to enable lending and borrowing for more of the long tail as well. So we had some optimizations that supported that, and we had quite a lot of markets on Euler. We probably had 50, 60 different lending markets compared to Aave Compound, which were probably fewer than 20 at the time. So they were very much short tail, and we were catering to a bit more of the long tail. And that's partly because of these interest rate models and other optimizations that we had. But certainly it was more of a monolithic architecture than a modular one at that time. And ultimately the modular architecture of V2. Yeah, go ahead.
Pause on that before we go into two. Would you say um, the fact that Aave and Compound had like more of the blue chips pairs, but you had more of the long tail ones, was it a strategic thing, or was it also due to potentially a better flexibility of the protocol?
Think, I mean, it was, at the time, it was partly go to market. Yeah, I mean, you have to differentiate yourself from, when, in a market like lending and borrowing, you have to offer something different. So I think certainly it helped to be able to support those markets and as a go-to-market strategy. I think at the time, though, the main demand for lending and borrowing ultimately was on the majors and the blue chips. It was effectively people who had a large amount of Bitcoin or ETH and wanted to borrow against it. That was the prime use case, which is still a big use case today, of course, but probably not the most common one. Today, people are lending and borrowing far more to arbitrage and trade interest rates than they are necessarily to want to go long ETH or long Bitcoin. So that people tend to use perp exchanges these days more often than not. And so back then we assumed people might want to go long or short the long tail of assets as well. And there was limited demand for that. Ultimately, Euler V1 ended up being successful because of it was an even better place to trade majors as well. So we came with the long tail as a kind of an entry point to the market, but where we actually grew market share was because we had we had an easier flow for borrowers. We were kinder to borrowers and made it much easier to do to set up trades effectively on Euler than other platforms. And that's actually where we won market share, not on the long tail really. It turned out there wasn't huge demand for long tail lending and borrowing.
Interesting. And sorry, I kind of stopped you, caught you. You're about to talk about V2 and how you got to that design after V1.
Yeah, I think it was I think I was effectively just going to say that it was we realized that V1 wasn't catering to all the different needs of the market effectively. That was an interesting product launch. We wanted to keep it one product and focus on a particular use case. But when we realized that use case, there actually wasn't huge demand for that, but there was huge demand for other types of emerging use cases about trading interest rates and stuff. We realized one single big global market isn't going to solve this problem. It's too exposed as a single market to all the different things that people want to do, and there's huge differences in people's natural tolerance for risk and reward. Some people want to go max degen and lever up and trade interest rates at 10, 15, 20x. Other people don't want to do that. They just want to lend passively into a pool that doesn't have too much collateral exposure. And yeah, you can't just build a single product. There's not one size fits all when it comes to lending and borrowing. It's a very multi-dimensional product space. And so we realize how, yeah, you either have to just pick one part of that space and optimize on it and build a single product for that. Another approach is to try and build something modular where you create a kind of kit of primitives and allow people to take those primitives and then assemble those into the products that might satisfy the wants and needs of the market for all these different use cases. And that's how V2 emerged really. That was our design choice. We just said we're going to optimize for flexibility and build a kit other people can build products with.
Yeah, that makes sense. And you often related to that. You often pitch Euler as a lending superhub. What does that mean for the end user?
I think it means that you can kind of build any kind of product with Euler. There's lots of different lending and borrowing protocols out there these days. And ultimately, it's a super app because you can build all of them with Euler. You can rebuild Aave, you can rebuild Compound, rebuild Silo, rebuild Morpho. All of those products you can rebuild using our developers kit. And so we're maximally flexible in that regard in terms of how as a product designer, or as a, some people call them risk curators or capital allocators, those guys who are making the markets and creating products for people have huge amounts of flexibility in how they tailor their markets to the specific needs and wants of users. So there's something for everybody on Euler, and I think that's what makes it a super app ultimately. Is it caters to many different needs.
Right. Can you talk a little bit about these creators? Who are they? And what kind of strategies or what kind of markets are they managing on Euler?
Yeah, huge variety of them. All different use cases, I would say. I mean, I should say that there's probably two types of curators in the market today, and we all use the word slightly differently. So I would distinguish between risk curators, in my opinion, are people that actually set risk parameters on lending and borrowing markets. So people like Chaos Labs and Gauntlet and others that have historically tweaked collateral factors and interest rate models and so on. There's a second type of entity that is actually also overlaps with some of those people. So Gauntlet did this as well in other platforms where they also call risk curators, but I would call them more capital allocators, where effectively assets get deposited into a vault, and that vault then the capital allocator decides which underlying lower level markets it deploys to. And it's managing risk in some sense too, because it can either opt to deploy the funds into riskier, higher reward markets or lower risk, lower reward markets, right? So there's some overlap in the meaning. On Euler, we actually have both of those entities. On Euler, the lower level markets can be structured however we like, just as we discussed. They're very flexible, like primitive units, vaults, as we call them, and you can connect the vaults together. The simplest possible market you can create is just a collateral debt pair where one asset is used as collateral. It's just held there in escrow, not used for lending and borrowing at all. It's just collateralizing a debt position in another vault. So some of the markets we see in Euler are simple collateral debt pairs designed for a specific set of assets. And like one of them is permission. So we have a permission market as well, or it's like permissioned either on the lending or on the borrowing side, or both sometimes. So yeah, we have like additional features like that that rely on hooks that allow you to adapt the markets to who can use them and such like. But on Euler, you can go beyond that as well, and you can effectively create a debt market that accepts multiple collaterals. You can create a debt market in which A is used to borrow B and B is used to borrow A. So that's called rehypothecation, where your collateral also earns you interest because it's simultaneously being lent out whilst you're using it as collateral. That creates a more capital efficient market, arguably with a little bit more risk, but more reward. So lots of different markets, and the curators in Euler, they can either structure those markets themselves to set up small or big markets with different vault connections, different LTV parameters, different interest rate models and such like. They get full control into creating those underlying markets, but they can also deploy capital to vaults or manage these upper level vaults, which will then deploy capital into their own markets or into other people's markets or to immutable permissionless markets and so on. And ultimately, that's the two roles that I'd say these kind of entities play, is that they're either capital allocators into our markets, and they get to choose and manage risk that way, or they can actually sculpt and create their own underlying markets.
Right. And you mentioned this concept of hooks on Euler. Can you detail a little bit on how they've been used to offer better markets?
Yeah, sure. I mean, one of the simplest use cases is for just basic permissioning. And permissioning can be used for a variety of reasons. Sometimes it's used for additional security purposes. You just limit to a certain set of whitelisted entities that can interact with the vault. You then know more about those entities. That hopefully makes things more secure. So some parties like to use them for that reason. Some are for like pure compliance reasons, like you have an asset that has some regulatory requirements, and so you have to add them for those reasons. We've got one curator that's now using them.
Linked to a KYC or where you would essentially need to have only KYC depositors and use that hooks and whitelisted the addresses as such, right?
Exactly, yeah. So dealing with like real world assets, like some of the tokenized T-bill markets, for instance, sometimes have additional regulatory requirements, and you can use hooks to kind of guide those and help ensure that the market's compliant with the regulatory requirements in a given jurisdiction. We have really novel use case recently where somebody essentially allowed a zero knowledge identity proof to be brought on chain, so that you permission not just on some generic whitelist, but permission on the zero knowledge proof, which means that you can not just check for like, are you on a list with this address? You can actually come in and provide information about yourself, but with a zero knowledge proof, right? That I can say, yes, I'm an accredited investor in a certain jurisdiction, and I'm within some age range or something, some really specific details about myself, and I can provide that as a proof, but without actually giving that information up on chain. So it's a very, very cool use case that's a lot of institutions are warming to, I would say, as a kind of future way to help better secure the markets, maybe provide additional compliance requirements. But you can also use them for in conjunction with other like strategies. Basically, if you're a more advanced lending borrowing user, you can use hooks in conjunction with something called operators on Euler. An operator is like a specialist smart contract that you can delegate access to your account for. So let's say you were setting up a position where you were wanting to go long ETH. You would deposit ETH as collateral, borrow dollars, buy more ETH, and supply it into the market. You're now worried though that what happens if ETH starts to fall in price, right? It might get liquidated. Maybe I want to set a stop loss on my account so that I exit my position before I get liquidated. You can use operators this way by delegating access to a smart contract that can be called, and it can only do one thing, the smart contract. It's basically can unwind your position. And what you'll do is essentially specify an intent for that to happen. And then the intent can be triggered upon some condition, like the price of ETH, for instance, and that will help unwind this, allow somebody else to come in and you pay them a small fee to unwind your position for you. So you get like much more advanced rebalancing mechanisms on your account and triggers to help you better manage risk as a lender or a borrower on the markets.
And talking about rebalancing, it seems you've been the first major lending borrowing protocol platform to integrate swap into the mix, coming back as well to this super app idea and vision that you have for Euler. Can you explain what Euler Swap is and how does it help traders, LPs on the platform versus going directly through AMMs, for example?
Yeah, sure. Let me tell you about the issues with classic AMMs first, and then I'll tell you how Euler solves those and then how we actually achieve it. So the issues with AMMs generally is that they're very, very capital inefficient. You put assets in as an LP, and if you think about it, most of the time those assets are not being used productively at all. There are many blocks on which there are just no trades whatsoever. Even on blocks where there are trades, your assets are often out of range or not being utilized by the swaps that actually happen. So a huge amount of capital is wasted there. And in TradFi, that's just not how things work. You don't actually literally put liquidity of certain stocks on an order book and it sits there. Typically, it's held elsewhere where it often earns some kind of yield and then is brought back into the fold, effectively where everything's settled up at the end of the day or the week, and kind of distributed that way. In DeFi, we don't do that. We just put assets literally on the order book, and it's very, very wasteful and unproductive use of capital and assets effectively. The other big problem that DeFi's had for ever since I came into the space is that people want to borrow against their LP positions. You've got valuable assets on Uniswap or Curve or wherever else. They're already being used unproductively, but now you want to borrow against your LP, either because you want to increase the size of the LP position, you might want to leverage, borrow against it, redeploy more LP assets so that you get deeper liquidity in the market. Loads of projects do this to help deepen liquidity for their stable coins and things. Sometimes you want to hedge risk, so you want to basically borrow against the LP so that if something bad happens to the LP, you have like an insurance, like worst case scenario, maybe you keep 90% of the assets because you borrowed against it. Loads of LPs do this already today and market makers do this, but it's just really hard to do it in DeFi. So where does Euler come in? On Euler Swap, all the assets go into Euler's vaults first and foremost. So they're not sat inside a DEX on some order book. By default, they sit inside the vaults. And the assets are then used more productively because they're pulled just in time to provide liquidity for swaps as and when they're needed. They're not by default sat on the swap order book, which means at the baseline, a lot of the assets actually earn lending and borrowing yield from Euler itself. So you as the LP decide which vaults to use, what risks you're comfortable with, and your default is that you're going to earn lending yield on them. If you then also facilitate swaps, depending on how you set up the AMM, you will also earn swap fees. So it's already significantly more capital efficient than classic AMMs. Furthermore, because the assets are in lending and borrowing vaults in Euler, and we know full well how to price those assets, regardless of what the ratio of the two of them is, that means you can natively borrow against your LP position in Euler, and you can borrow against it to deepen the liquidity or to hedge risk. And one of the really cool use cases that's completely novel, primitive in DeFi is to use just-in-time liquidity. Effectively, if you put assets in Euler, because you're allowed to build up leverage positions, what we can do is I put my assets in, let's say some USDC in Euler, and you want to do a really big USDC to USDT trade. Your incoming USDC is going to be deposited alongside my margin USDC, and then we're going to borrow against the entirety of those assets, the margin plus the swap input amount, to borrow the USDT swap output amount just in time, and then send that back out to you. The really nice thing about that is that my LP position can facilitate swaps that are much larger than the LP liquidity I've put in. So we have one guy, for instance, that's created a $400 LP position on Avalanche, and he's done $500 million in swap volume or something insane over the past week. $500,000, sorry, of swap volume over the past week, which is just like an orders of magnitude more than the amount of liquidity he supplied, and we've never seen anything like that in DeFi before. So it's just insanely capital efficient to use this just-in-time liquidity feature, and that's it basically. That's Euler Swap in a nutshell.
And you mentioned this DeFi power users, and do you see other users of this capital efficiency through vaults, potentially LPs positions as collateral, and using the swap engine as you keep your capital efficient? Do you see other type of users already using that mechanism?
Yeah, so Euler's very much, because of the nature of the markets, is very much like for borrowing especially, it's extremely capital efficient and very powerful. So we see really high demand for borrowing constantly on Euler, which is why I think last I checked, we're like the fourth largest DeFi protocol now for active loans, fourth or fifth. So yeah, there's infinite demand to borrow on Euler always, because we have traders actively doing stuff all the time on the platform. And of course that generates more yield for lenders, and lenders tend to be more passive. They tend to be effectively more like a senior tranche where they're happy to lend for long periods of time, and they come in and they tend to be, I don't know, other retail users or whatever. And so that's where integrations with yourself come in, because lenders can come in and supply without having to know about how to run a swap operator account and to do all the, the strategy-based trading and stuff on Euler. They don't need to do all that to earn yield. They can just supply passively to a lending and borrowing vault. And they can either do it directly themselves into the lending markets, or they can do it through a managed vault where capital allocator then supplies to different markets on their behalf and tries to manage the risk reward for them. But we certainly see all different types of users on Euler. But it's the sophisticated nature of the underlying markets when the advanced DeFi power users help generate a lot of borrowing demand, which then filters back into higher yields for lenders, which is partly why Euler's grown so rapidly over the last 9 months or so. It's just constant demand for borrowing, driving yields, driving growth.
And before we come back to this growth, just maybe last question on the collateral type. You mentioned LP's position. What are you thinking on real assets that has its own differentiation and complexity as a collateral, and how would the protocol adapt to this, I would say, new TradFi to DeFi world that is coming on chain?
I think it was built for these assets with these assets in mind from the very beginning, which is not the same for all lending protocols today. We can accommodate these assets very, very easily in Euler. We were the first to launch markets for the SBIDL product, securitized, managed BIDL integration with BlackRock, which has been going very well. We can do customizations to help handle some of the extra requirements these assets sometimes have. And one of the coolest things I would say about Euler Swap is it provides a way to bring liquidity for these assets on chain. Because of the permission nature of the assets, we often don't really see any DeFi liquidity for them. There aren't really permission pools on Uniswap for real world assets these days. There's just no liquidity. Instead, what a lot of projects have to do is use the instant redemption facilities or redemption facilities for the assets. Now, those instant redemption facilities sometimes aren't open. They can be closed at, on holidays or weekends or whenever the facility isn't topped up with additional capital. They're not always atomic. They don't always allow you to just, atomically transfer in the asset and get USDC back out. There's lots of complexities with instant redemption facilities. Euler's already really well set up to handle those. But with Euler Swap and just-in-time liquidity, we can actually make an atomic form of instant redemption facility on the lending borrowing protocol itself. And this is something like a lot of institutions are really excited about, because I think it can help them scale these products up more quickly. The basic idea is if you just have one LP, let's say a market maker that's whitelisted to use a certain real world asset, they deposit a small amount of the asset as collateral. They put $1 million into an account, and now they enable 20x just-in-time liquidity facility. What that means is that, Laszlo, you could swap in $20 million of that real-world asset, and the market maker account would then borrow $20 million of USDC just in time and send that back out to you. That means that we've now facilitated an instant redemption facility that's atomic on-chain that liquidator can process, or whoever can use, you as a swapper can use, on-chain today for real-world assets. And it's fully compliant with all the existing requirements people have. Like the market maker is able to hold the asset because it's a regulated entity on the whitelist and so on. And it's really just opened up a whole new way to create liquidity for real-world assets. And the really nice thing about it is that the way that the AMM works under the hood is that when someone swaps in that amount of real-world asset, there's a curve. And effectively, as you trade along the curve, you open up a small arbitrage opportunity so that the market maker might not even have to go and close that position out after the swap, they now hold a lot of real-world asset and they now hold some debt in USDC. How do they close out the position? They could either do it themselves with their inventory, or go with the asset issuer and try and close it with them after the weekend or whatever. But the cool thing is that because the curve opens up arbitrage opportunities, it might be that other people in the market now just arbitrage the position back and close it on their behalf. Effectively buying the real world asset at a slight discount in order to close out the position. And the market maker wins because they're running swap fees, and the asset issuer wins because they are now providing deeper liquidity for their assets on chain. But really, really cool use case that we're really excited about for Euler.
That's super cool. And you kind of overcome the off-chain 1 to several days redemption requirements, or even weekends on liquidity of the assets on-chain. That's cool. You want to come back on the several months of growth you've experienced, and so first of all, why do you think that happened? What do you think we went from near zero or close to a couple of million of TBL end of 2024 to, I think, 1.7 billion TBL today? Just a massive growth. What happened in these several months?
Yeah, I think we tuned a few things. I mean, firstly, when we first launched, we didn't have an incentive package for lenders and borrowers. There was a lot of interest in another protocol at the time, and so a lot of the curators were still figuring out how to use other protocols. And that meant it was a little bit slower to onboard them onto Euler than we would have liked, and we didn't really have the budget, frankly, to incentivize and pay for like liquidity or anything like that. So we had to go a different path. What we managed to do was persuade just one or two smaller curators to come on Euler, and they started to build markets that they realized they just couldn't build elsewhere. And those markets started to grow very, very rapidly because they were satisfying market needs. So one of the markets, for instance, was run by a curator called Apostro, and it focused on the Resolve asset. Resolve's like a smaller competitor to Athena, by the way, if people are familiar with it. And ultimately it was just a more capital efficient market than any of the other like protocols at the time. Couldn't be serviced by Aave, was not available on Morpho in the same way. And it just took off. It did very, very, very well. I think when people started to observe that you could just do things that you couldn't do elsewhere, that natural product market fit helped things grow really quickly on Euler. And then slowly but surely, more and more curators have slowly like come on board and started to create those markets. The nice thing about the curator model is that these guys often have their own contacts, their own address books. They're figuring out the market. They know better than we do often what kind of products are likely to be popular, what the kind of demands and needs of the markets are. So we don't have to know about every single asset and build specific products ourselves for the market. Other people build them for us, and we focus on the underlying infrastructure and the technology solutions essentially. And by doing that, we've been able to scale really quickly. We just take care of the tech, and other people take care of the products on top of that tech.
Makes complete sense. And congrats again on this amazing growth. Something I want to come back, which is actually a bit related. Beginning of 2023, the protocol had like already major growth. You were hacked, and I think $197 million was stolen. But you definitely come back to it since you've close to 10x since then. So, how did you manage to recover from this hack, and how did you and how did it make this protocol and Euler Finance stronger?
Yeah, I mean, it was a really devastating event. It happened just 4 days after the birth of my son as well. So it was a very traumatic event. I think, we obviously managed to recover. We actually hunted down the attacker and persuaded them to give all the assets back. So we ended up recovering more money that, in dollar terms than was stolen. So we got 240 million back for lenders and borrowers on the protocol. I think we had a lot of sympathy among the DeFi community and broader security community, especially because Euler was more heavily audited than other protocols at the time. We had the largest bug bounty of any lending borrowing protocol at the time. And so it was clear that we hadn't, we built this thing with best principles in mind at the time. We worked on formal verification, all the really best in class technology. We tried to go the right path, and ultimately it wasn't enough. Euler's not unique in that regard. I think all the major lending protocols have had critical vulnerabilities at some point discovered in production, and it's partly because it's a nascent industry, or has been a nascent industry, and security teams are still figuring out have been figuring out attack vectors and things. I think over time you can see that things have been improving a lot, and security practices have been improving. On Euler V2, we've really set a brand new standard, I think, for security. I mean, we've now had over 40 audits of the V2 protocol by 16 different firms. We've got a comprehensive fuzz testing library, a comprehensive formal verification suite. We brought security individuals to come in and monitor all the process during the development pipeline. All of the audits came back exceptionally clean. We did the largest Cantina bug bounty competition in history at the time. No one found any mediums or high in that, despite the fact we had about 150 security researchers involved in that process. Even once we'd done that, we then launched a capture the flag competition where we put DAO money into the protocol as protocol and liquidity, and we invited people even after that contest in case they'd found something and didn't, weren't sure we'd pay out of it. Just said, there's money, if you want it, go and take it. And obviously no one did. So we've really been pushing as hard as we possibly can on security. Even just the design of the protocol and the way it's modularized was partly driven by security considerations, thinking modular is best because you get these well-contained components that you can, that they do one thing and do that one thing exceptionally well. And then you can audit that individually and make sure it does exactly what it says on the tin. And then when you build products and you compose different modules with one another, you can then audit the entire products themselves as well. And so that's how Euler's effectively been built. Multiple modules, all audited independently, and then when they're packaged up into the entirety of Euler V2, that all gets audited comprehensively multiple times using different types of audit process as well. So yeah, that's how we've strengthened after that awful event.
Yeah, that's very impressive. 40 audits, 16 different firms, the largest bug bounty contest year. I didn't know about this 150 different security researchers looking at the code and finding nothing. And also, as you mentioned, which it seems you were doing in the past already, but using companies like Certora for formal verification of the code. You know, we've as Kiln, the company, we've been building smart contracts since 2021 with most of our partners. I think we have close to 3 billion in TBL, mostly in staking contracts, and now in DeFi ones. And coming different audits and knowing this process, it's quite impressive what you've been able to show as like upgrading essentially the security standards in the space. So congrats on that.
Thanks. Yeah, I forgot to mention as well, we've also got, I think, the largest lending protocol bug bounty today as well. We've got $7.5 million bug bounty on Euler. So if you find something on Euler that's critical, could drain funds, like come and tell us, and you get $7.5 million. We've tried on every angle possible, and I think we got a lot of positive feedback. We also have active monitoring by several firms actually as well, monitoring the contracts, and helping us on like the day-to-day now. So even after audits and even after launch, there's still more happening.
Yeah, which is to my understanding still the largest of any lending borrowing protocols out there. And I guess transitioning to that, when you look at other competitors in the market, let's say AVV4 or Morpho V2, how do you differentiate yourself and essentially potentially related questions like how do you see Euler in the next 5 to 10 years?
Yeah. I mean, I think what we've always said is that you can build other lending protocols using the Euler developer kit, but not the other way around. So other protocols tend to be packaged up as specific products. So you can recreate a Morpho like structure on Euler, for instance, by deploying like little markets that are collateral debt pairs and then having the vaults deploy into those. That would be exactly like the same setup as Morpho, if that's your preference for how things should look. And it works very well for certain assets, right? But it's not everyone's cup of tea, and there are different ways to structure markets, more capital efficient ways, perhaps. So people prefer those. The Aave way of doing things is historically been this big monolith, similar to like what Euler V1 was. And it's certainly the most capital efficient way, at least probably today, to do things. That's why you've seen lots of growth on Aave over several years now. And you can rebuild that kind of structure on Euler as well. So I think we differentiate ourselves because we're very flexible, and we build for builders really and build infrastructure, whereas other people tend to build more specific products for specific use cases. And that's how we kind of pitch ourselves, I suppose, to we build for these curators first and foremost, and then let them build the products for the people. And in terms of like the future, I think we still have lots of cool things coming and shipping on Euler, built on top of this modular kit. We've got fixed rate products coming. I think fixed rates are going to be massive in DeFi. Historically, they've not done well. And I think part of the reason for that is that was just the use cases available, the size of the market and everything was very much smaller in the past. So fixed rates tend to fragment things a bit more, make things more fragmented. We actually have 2 products coming in this regard. One thing we've got is called a cyclical rate market, where you have a flat fixed rate for borrowers for a period, and then you change the interest rates during certain periods to incentivize certain user behavior. That's going to be a completely novel DeFi primitive, and we'll be launching that really soon. And that will, I think, help solve some problems for borrowers, because right now, when they're doing these interest rate trades, they tend to get caught out by variable rates quite a lot. When the variable rate spikes, that makes their carry trades unprofitable. And so they have to then unwind and then rewind and unwind. And so in a lot of protocols, you see that borrowers just have a horrible time. And yeah, we want Euler to be the best place to come and borrow. So we've got this new product coming for borrowers there. Yeah, we've got a longer term, another type of fixed rate product. We've got order books coming for the swap protocol, which will allow people to effectively earn interest whilst they set limit orders on the protocol. Yeah, a new class of earn vaults coming. There's lots more that we're shipping. And so in terms of the future, I see as being a home for liquidity in DeFi. Our goal is to target institutions and really sophisticated borrowers. I think that's we build great tech for that particular use case, and I think that's where the interest comes from. That's where we generate interest, and so with that, we hope to then onboard more lenders as well. But yeah, institutional grade lending and borrowing is our pitch for the future.
Indeed. And of course, fixed rate will brought to the platform will definitely help that. Maybe one very last quick question, and then more global one. How big is the team? Because you're doing so much, you're shipping so much, and it seems you've managed to stay as a relatively small team compared to the amount of code and features you're shipping.
Yeah, we're actually not a million miles away from breaking even, becoming a profitable project, even after just like 9 months really of growth. So we don't have a huge team. I think we're about 25 people. I don't know the exact number these days. But yeah, we like to keep a small, close-knit engineering team where everyone takes responsibility for tasks and not try to grow things too large ultimately. Yeah, I don't want Euler to be this big, massive organization where no one really takes responsibility and you get I think there's a certain size at which engineering teams start to not work that well anymore. And yeah, so we like to keep things fairly small at Euler. I think we could probably grow a little bit more, but I wouldn't want us to see us get hundreds of team members or anything. You can maybe do that on the business side, but certainly not on the engineering side. We have like an exceptionally talented engineering team at Euler. And so, yeah, we're very fortunate about that.
And that's interesting to know. That's definitely a topic where I'm always super interested about how do you recruit, how do you find these best talents, and at Kiln we get to closer to 100 people now. I definitely relate of like there's a point where you need to reorganize the organization. Otherwise, you don't get faster with more people. But
Yeah, you get diminishing returns over time, and you can actually like end up making things slower, more bureaucratic, and less decision making, and so on. I think there are trade-offs. It really depends what kind of organization you have. Like maybe on the business development side, you can scale that team and have that much bigger. But like on engineering, I think I personally like to keep things kind of close knit and have everyone really focused on the things that they do well and they're specialists in. Yeah, and have everyone take like responsibility. I think I've heard that Elon Musk likes things like that as well. So I don't know if there's any comparison there, but I think, yeah, I've heard that when engineering teams get too big, they start to fail and fall out and like disagree, and things just become too bureaucratic. So we try to make sure that people can make decisions and keep moving things forward. I think that helps us build great products and great technology, but also like ship faster as well.
Yep. Couldn't agree more with that. And maybe very last question, opening one. What are you excited these days in crypto, DeFi, the world? Could be anything. Yeah, and if you want also to recommend another person that should be interviewed on the podcast, would love to meet and talk to that person.
Oh, good question. What am I excited about? I mean, generally, just it's quite clear, I'd say these days, that all of finance is going to come on chain. I think that's. I've been saying that for years and been very optimistic that would be the case. Almost like some people think irrationally so in years gone by, but it now seems more likely than ever that that's going to be the case. So I'm just very, very interested to see how that develops. And I think hopefully Euler can benefit from that as we see continued growth in stable coins and payment providers, and with the Genius Act and everything. I think that's going to create really great environment for continued growth in the industry. All the rest of it is just noise. So yeah, that's exciting. On who should you get on? I think like someone from the Pendle team would be great. I mean, I think just Pendle's awesome. They also had this thing where they just didn't have product market fit for a while, but kept building. and like showed a lot of resilience and determination, and finally found product market fit. And I think they crossed 10 billion total deposits the other day, and now just like, yeah, absolutely flying. So huge congrats to them. I'm a big fan of their team. I don't know if you've had them on yet, but I'd probably recommend them.
No, we know their team a bit, and you're right, they're just amazing. They've brought YTPT standards and in a way, the beginning of like a fixed rate market to a DeFi industry and ecosystems being more and more institutionalized and forward. So yeah, I think we'll definitely have them on the podcast. I think yeah, it would be a great next um, um, great next team to understand their stories and how they build the product and how they see the futures. Michael, thank you very much for your time today. It was a blast to have you on Kiln Rendez-Vous, and it was also a blast to understand more about your story and Euler Finance. And I hope we partner, collaborate, build together in the future.
Yeah, I hope so too. I think we've got a few irons in the fire cooking up some cool stuff. So look forward to getting those integrations done. And yeah, I'd love to come back on at some point in the future when we've got some new products out, and maybe tell you about those as well. But yeah, huge thank you for having me on.
Thank you.